We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrix. Joining me today is Senior Analyst at goldsilver.com, Jeff Clark. How are you today, Jeff?
I'm doing great, Tom. It's great to be back with you. Sure enjoyed talking to you last time, so I'm looking forward to this again.
Me too, Jeff. You have a lot of very good information to share with us. So I'd like to start by kind of getting your take on an article that you wrote a little while ago. Really relating to the vaccine news, and talk about the octopus of risks surrounding us. So why don't we give us a little bit about what could happen to the US dollar with Biden getting in, and why this could lead to a slow, long decline for it?
Well, this all started because there were a few analysts and some mainstream journalists commenting on gold, which why would you listen to a journalist on gold? I don't know. But anyway, they were saying that, hey, the vaccine's coming. This was right after Pfizer's announcement, right? Which was on November 9th. And of course, gold sold off, and all these analysts and journalists were saying, time to sell gold. We have a vaccine. We're going to get back to normal. So there's no reason to own any more gold. So dump your gold. And of course, I did not react well to that. I thought this deserves a comment. So that's what led to that article. And now I will admit, just to pull up the data here, since that announcement, gold is down about 6%. The S&P is up 4.5%. So on the surface, it would seem like maybe they were right. However, if it was time to sell gold because we had a vaccine, gold should be down around $1,000, right? It should have sold off by half or whatever. It has not even done anything close to that. So anyway, I wrote this article because I thought you guys are missing, you're looking at one small part of the elephant, and you're not looking at all the other risks that are out there. One of which, like you bring up, was the US dollar. And most of the institutional analysts that are out there were saying, look, the dollar is going to get weaker. And the primary reason the dollar is going to get weaker is because of the monetary and fiscal stimulus that politicians and central bankers, and starting with the Fed, are going to continue to do. The more you print currency, the more you add stimulus, the more you add currency to the supply, it dilutes the value of existing dollars. And that's why the dollar is going to go down. Some were saying as much as even 20%. So, and then you add in Biden wants to do this Build Back Better, I think he calls it. And the package for that, the proposal anyway, is $7 trillion. For infrastructure spending and all that. And sure, we could use some infrastructure spending, but to spend a third of your annual GDP on that project, those kinds of projects, is insane. He doesn't have that much, there's not that much currency there. There's not that many funds available to pursue that kind of program with, unless you print it. So that's what's going to have to happen for him to pursue these options. And it looks like he is going to be president. We'll see, but if he is, then we can expect ongoing massive dilution fiscally and monetarily, both from politicians and the central bank side of things. And that's what's going to lead to a weaker dollar. So even if the dollar were to bounce in the first part of 2021, I don't think the end is nigh necessarily for the US dollar. So even if it bounces, that doesn't really change my view, because in the big picture, if you pull back and look at the big picture, the fundamental, the macro picture, the dollar has to get weaker because they have to print.
Yeah, and it just seems that even if that $7 trillion stimulus or infrastructure bill is introduced, that's still on top of, let's say, stimulus and all the other deficit spending that they're going to have, right, Jeff?
Absolutely. When's the last time you heard a politician say they balanced their budget?
I don't think those words
I mean,
exist except in a
that's a thing
negative
of the
context.
past. That's an archaic, that's a relic. Nobody talks about that anymore. The trend in motion is clearly dilution. It's spending. It's creating currency fiscally, monetarily. So that's the train that's rolling down the track, and that's, that train's not going to stop anytime soon because they can't stop it. That's what they have to do to service the debt, to service the economy, etc.
So Jeff, as we think about how much, currency is being printed and put into circulation, obviously, again, you would think that this should be very inflationary, but there's a couple factors at play here. And especially with the lockdowns, monetary velocity seems to be deflationary, right? So give us a couple of the, let's say, different forces here that we're playing with, and also the inflationary realities that you highlight in the article, please.
Yes, that article came as a result of, a lot of things that are happening now and still happening in spite of the first person getting the vaccine now are deflationary. And there's a lot of deflation out there that still has yet to play out. But inflation is a reality based on history from the perspective of two things. And that is, first, the debt. There's been many long-term studies done on the relationship between excessive debt levels and inflation. And it's regardless of what other forces may be going on at the time, such as deflation. The best example of that is the 1970s when you had stagflation. You had, soaring interest rates, you had high unemployment, you had a stalling economy, you had an energy crisis, Russia invading Afghanistan. I mean, the list of deflationary things went on, and yet we still had inflation. So inflation can happen simultaneously with deflation. One of those issues is debt, and historical studies show that. And the other one is deficit spending. And in that article, I did an updated chart on the linkage between deficit spending, running high deficits, and inflation. And the US just a few months ago hit the highest level of deficit spending in its history. So if these historical studies are right, we can have deflation, but the reality is because of debt and deficit spending, inflation can easily happen as well too. In fact, it probably will. These historical studies would say it's inevitable. The timing doesn't say how long the timing could be or when it could be, but it does say those things are coming. And so I'm personally preparing for inflation on some level, even if we have some deflation. So even if we have currency velocity, the Fed measures, they call it money velocity. Even if that is stagnant, you can still have some inflation. In fact, there were periods in the 1970s where the currency velocity was low, and yet we still had inflation. Inflation can result from wage increases. If wages go up across the board significantly, that can spur inflation. So there's a lot of factors that play into this. But again, looking at it from the 30,000-foot view, history says that inflation is highly likely based on government actions of debt and deficit spending.
Mm-hmm. And I think one of the other, like, as you say, the 30,000-foot view, if we really look at one of the other factors that is at play here, is the fact that the Fed really can't raise interest rates to battle inflation once they actually start getting it. Is that right?
Boy, isn't that true? Because, look, I don't know what the recent percentage is of interest payments to service the debt and what percentage that is of the budget. Oh, pardon me. But it's a high percentage, and there's no wiggle room in the budget. They already can't balance a budget. What's interesting, though, is if we do get inflation, and it starts to rise significantly, all these other countries are going to demand higher interest rates on their bonds and treasuries and all that. And that could be a predicament for the Fed. But you know what? Even if they do raise rates, for me, that isn't the issue. The issue is what the real rate is. What is the real rate of inflation? Meaning the rate of inflation that is measured by the CPI. It's the 10-year treasury. That's usually the benchmark that's used, minus the CPI. And if that's negative, those are negative real rates. And that's what we have right now. Inflation is higher than what the 10-year treasury pays. So even if rates go to, if they go to 5%, which seems outlandish, but if they went to 5%, but inflation 6%, you still have a negative real rate. And that is still a positive environment for gold, as history clearly shows.
Mm-hmm. And one of the other factors as we look into, let's say, 2021 here and this Biden administration, was that the other day we saw that Janet Yellen is probably being appointed as Treasury Secretary. So what is some of her really contradictory wording and actions from the past? How is that going to affect us going forward, Jeff?
I will never forget this thing that she said after she left office as Fed chair. You remember she was Fed chair for a while. She said, I want to get it right. She said, the U.S. debt level is something that should, quote, keep people awake at night. She actually said that.
And do you remember what year that would have been?
Well, I don't, but it was the year after she left as Fed chair. So whatever year that was, that's when she said that. And she said that publicly. I still have the quote written down somewhere because I couldn't believe it. And of course, she said that because after she left office, she was more free to speak her mind. And yet now that she's Treasury Secretary, what is she almost guaranteed to do? She is going to work hand in hand. The Treasury Secretary is the chief economic advisor to the president, whoever the president is at the time. So she's going to be advising basically the only tool she knows, and that is to print. So she's going to be working with Powell and Biden to basically dilute the currency even more. That's an easy call right there. We know that's going to happen. And that's yet more evidence that there's going to be more dilution of the currency. There's going to be more stimulus. There's going to be more QE, currency printing, all of that. There's going to be more of that. All of this is supportive for gold.
Absolutely, Jeff. Again, it's just taking these 30,000 foot views and really seeing that this is all very supportive for gold is something that I think we really need to focus on. So there was another part that you and I were talking about a little bit about new gold and silver supply and where new bullion comes from. And you were mentioning that it could actually fall dramatically. So could you tell us a bit more about that, please?
Yes, that's a trend that's in motion, and this is a years-long thing that's playing out. I don't recall if we talked about this in our last interview, but basically you have new mine supply rolling over for gold, and it's already in a downtrend for silver. Most consultancies out there that measure this data and track it are reporting that gold and silver new supply is going into a structural decline. It's not something that can be easily turned around. There are multiple reasons for that. The low gold and silver price that started back in 2013 is the first culprit of that. I mean, the prices dropped so dramatically that from one quarter to the next, you had some silver companies that went from profitability to being unprofitable solely based on the precipitous drop in the silver price. What did they do? They had to stop exploration. They had to stop development, or at least curtail it. They had to focus on high grading, mining the highest grade portions of their mine. And they don't do that. What a lot of miners do is they mix the ore. So they'll get some high grade ore and low grade ore. They'll mix it together to get an average that they put through the mill. And the reason they do that is they want consistency. They want to show a consistent level of production, hopefully growing production, but they want a consistent level. That's what analysts want. So that's what they do. So if you take away the high grade, what's left is the low grade, and the low grade doesn't work without the high grade. So the only way this is going to change is through higher silver prices. and not just higher silver prices, they have to be sustainably higher. In other words, before a CEO of a mining company is going to spend millions and billions of dollars on exploration development of new mines, they're going to have to be convinced that the price is not only high, but sustainably. It's going to stay up there so that they have time to build projects and develop mines to increase their output. So that's why it's structural. It's not something that can be changed very easily or quickly at all. I mean, it's like the difference. The price is like a little speedboat around in the ocean, whereas new mine output is a big cargo tanker that's trying to negotiate a 3-point turnaround inside a port. So it takes a long time, and it's not easy to do. So mine supply, even though prices are higher this year, and it is spurring some more exploration. But again, it's structural. It's going to take time. It's going to take years for this to really turn around. So what's interesting, I think, is that, and the reason this is important, by the way, is because I'd say roughly 2 out of 3 ounces that are bought by investors every year comes from new mine supply. It's not buying and selling the same old product. It's new product. So you need new product to keep filling the pipeline, to keep filling demand. So you have falling supply, and we're going to have rising demand here. We still see higher demand than our average from last year right now. So at some point, there's a crunch point there where it just doesn't work. And all we need is some other type of crisis for demand to spike again, right in the middle of falling supply. And that could be a real issue for the market and drive prices higher.
Mm-hmm. So if we try and, again, kind of look at the timing of all these factors coming together, has this created maybe one of the last really good buying opportunities for gold and silver? And as Mike likes to say, before it comes unobtainium and unaffordium?
The reason I said in that article that this could be one of the last great buying opportunities is because when you have the big picture in mind and you look at the big mega trends, the macro picture, that the Fed, other central bankers, politicians have to continue stimulus efforts, that we have negative real rates, and they said they're going to keep rates low. We're going to continue to use our tools as long as we absolutely have to. They've said that they'll be doing this for the next 2 to 3 years at least. So you have negative real rates, currency printing, dilution. All the while, you have a Fed that doesn't have a lot of tools left. So looking at this big picture, and there's many things we could talk about in the big picture, but when you look at the big picture, and then you look at someone who comes along and says, you need to sell your gold because we have a vaccine now, that sell-off for me represents a buying opportunity. And the bigger the sell-off, the bigger that opportunity is for me, because in the context of the big picture, I'm confident of where I think gold and silver prices are going. March was a good example. We saw the gold-silver ratio, for example, go to the highest level it's ever been in recorded history of mankind. And I jumped on silver that month, March, twice. I bought. I think the lowest I got was 1305. Boy, don't we all wish we could go back and buy silver for $13. So these huge sell-offs, to me, are buying opportunities. So that's why I said that, because in the context of the big picture, where do you think gold and silver are really going? Is the bull market for them really over? Is the need to own them really over? To me, not even close. That's not even a reasonable question to ask. So because of that, any sell-off to me is a buying opportunity, and any big sell-off, like if we had another March, that's a back up the truck moment for me.
Mm-hmm. So let's flip this on ahead a little bit, Jeff. And I want to ask you, what would be maybe the type of scenario where you would actually stop buying gold and silver?
Well, the answer to that is show me that there is no more need to print currency. Show me that you can balance your budget. Show me that you're not only not adding to debt, but you're paying your debt off. Show me there's no more geopolitical risk. Show me that the vaccine absolutely is going to work. what if it doesn't work? What if it's not as effective as they said? What if somebody gets sick from it? I mean, there's way too many questions of it. It's way too early. There's been essentially no human trials, really to speak of for that. So show me all of those things that we have a healthy monetary system, a healthy fiscal system, honest politicians. That'll probably never happen. But show me all of that. And sure, yeah, I'll reconsider. Yeah, maybe I'll sell my gold then. But nobody can show me that. Nobody can. Even someone who's extremely pro-government can't show me that. So the need to own gold right now, just at this point in history, is still very, very high. I just think there's too many risks out there, and no one can show me those risks are low or falling or gone. So therefore, that tells me, just as an investor, as a citizen, that I need to continue to own gold and continue to buy it.
Excellent, Jeff. So I'd like to kind of move on to another one of the articles that you wrote, and it was entitled "Why Financial Planners Shriek at Your Portfolio," or my portfolio in your case, right? So tell us a little bit about why traditional, let's say, financial planners would shriek at your portfolio, and can you give us some of the let's say structural ways that you think about building your gold and silver portfolio?
Well, there's actually a story to this. I met with a financial planner in 2005, and I'd actually had him for a while. And, just let me say, he's a nice guy. I could actually see myself having a barbecue with him in his backyard. He was a nice guy, but he was trained and educated, by his employer to push a certain model and certain kinds of investments. So anyway, we met in 2005, and we would meet, I think, twice a year or something like that. And we would fine tune the portfolio, and diversification was really big with him, but that diversification was only in stocks and bonds. That's it. That's all he sold was stocks and bonds, Even if there was a real estate investment in there, it was some sort of stock in real estate, right? Well, this is when, back then, if you remember, stocks are starting to get overvalued. That's in the middle of the real estate bubble, which still had another year to go. But real estate was getting frothy. Debts were just out of control. Stocks were still going up. They were getting to nosebleed levels, which, it's even worse today. But anyway, I was getting concerned. And I told him, look, I'm just not comfortable with this. I think things are overvalued. Well, that's why we buy bonds, Jeff. I said, well, I'll tell you what. I've been buying some gold, and I also inherited some gold. And I showed him what I owned. And it was a sizable portion of what my total investment portfolio was. And the look on his face was priceless. He just got shocked. He just couldn't believe that I would have a third of my investments in gold at the time. And he said something to me like, physical gold, you're taking way too much risk. What are you going to do with physical gold? And I mean, I just, this is before I was working as an analyst, and I was just flabbergasted, but it told me on the inside that my gut was, okay, I'm on the right track here, because, to assign it no value in light of all these, circumstances that are going on right now seems kind of absurd to me. So I stuck with my plan, and I eventually left him because I just wasn't getting any value, constantly rebalancing a stock bond portfolio. Hey, if that works for some people, great, but it was not going to work for me. And it turns out my gold silver portfolio has outperformed his stock bond portfolio in any way you divide it up since 2005. Gold has outperformed stocks. Silver, stocks have outperformed silver, but gold and silver have tripled what bonds have done since 2005. It's even a bigger outperformance since the year 2000. So it turns out my gut was right. But that's what led to me saying, and that's my Twitter handle, Financial Planners Shriek at My Portfolio. And it's because of that appointment that day, and I saw the look on his face. And, I think we're still on the cusp of that. We've got a long way to go with gold and silver right now, but that's what started all of it back then.
So, Jeff, can you kind of break down, let's say the structure of your portfolio? Let's say, is it mostly physical and then some miners? What does that look like today for you?
So, what led to me still having the portfolio I'll tell you about in a minute was three things. First of all, it's the risks that still surround us today. That's the kind of the stuff we've been talking about. Monetary dilution, like we've been talking about, that's still a strategy that clearly is going to be pursued by central bankers, not just the Fed, but the world over, and politicians through stimulus. And that the big one for me, though, is the current monetary system just isn't sustainable. I mean, if you, like Brent Johnson of Santiago Capital likes to say, if you believe in math, buy gold. I like to add to that, if you believe in magic, then buy into central bank and political promises. Otherwise, I'm going to own gold simply because the math doesn't work any other way. So because of that, my biggest position in my investment portfolio is physical gold and physical silver. That is the biggest percentage of my total assets. The second is mining stocks. Now, most people probably shouldn't do what I do, but I've worked as a mining analyst, so I feel comfortable, pursuing that sector and taking those risks. And I will say that recently, the mining stock portfolio portion of my portfolio surpassed the value of my physical gold and silver holdings. Not because I was buying so many more stocks, but because they went up so drastically here this year. I shared on a video at a Peak Prosperity conference that I did. I actually showed the balance of my mining stock portfolio over the past 12 months. It was one of them anyway. And it had done 4X through 2020. I mean, there isn't anything else out there that's done 4X. And I'm not saying it's going to necessarily do that again over the next 12 months, but I think that's the kind of thing that mining stocks can do. And because that happened, it actually, the value of my mining stocks was greater than the physical gold and silver. Now they've pulled back, they tend to pull back more than gold and silver too, but that's kind of leverage you can get. And then the third thing is I do own a lot of treasuries. Simply because, that's what the only thing some funds will let you do, like 401ks and stuff like that. I'm not going to invest in the stock market with that. So I'm in treasuries. I also have a lot of cash, not just for liquidity purposes, but for buying opportunities as well. And then the last category is the crypto market. I have some exposure to cryptos and Bitcoin. So they're roughly in that order. And that's it. I don't own Apple. I don't own bonds. I don't own real estate other than my home. I'm focused on that angle of the market. And it's not because I'm crazy or just want to be a contrarian. It's because that's where I think at this point in history, that's where we need to be. Based on everything surrounding us right now, that's where I think is the most, that's the best combination of both protection and profit for me. Again, that portfolio isn't necessarily for everyone, but based on where we are at this point in history and the circumstances that surround us and what's likely coming ahead, that's where I want to be. That's where I think I need to be.
Mm-hmm. So one of the questions that's been brought up to me as we've discussed miners and stuff like this, Jeff, is the considerations around, holding a miner and then having to sell it back into, let's say, a worthless fiat currency. So how do you go about thinking about, how you're going to sell your miners and actually get some real value back out of that?
That's a good question. The reality is no government really is going to let us, do a direct transfer of gold or a gold stock into a piece of real estate, for example. You're going to have to go into currency and then use that to buy something else. But that's the same with any stock, any bond, any other investment, a government is probably always going to require us to transfer first into the currency. They want to track that, and of course, they want to be able to tax that, as well. So, but that's not the ending point. The purpose isn't to buy fiat currency. The purpose is to use the fiat currency as a transactional denominator in order to get into something else. And so for me, what I'm doing is when I've been taking profits on the miners, for example, I'm using that to either build cash or to buy other miners, that I think are undervalued or might have a compelling opportunity. So the goal isn't to go into fiat currency. That's simply a transactional thing that we're going to use to take a step into something better. And someday, by the way, we are going to exit this sector. I am going to sell most of my gold and silver stocks, most of my bullion holdings. Again, I know some people may disagree with that, but we're going to get to it. If gold goes to $5,000, $10,000, I'm going to participate in the wealth transfer. Let's put it that way. I'm going to sell a lot of that and use that to buy not currency, but use that to buy other undervalued assets, whether it be real estate, stocks, companies or businesses, maybe something for my lifestyle, a second home, whatever. So the goal isn't fiat currency. The fiat currency is simply a transactional thing that we're going to use to step into something that is also, dramatically undervalued at that time.
So as you're talking about, really transferring the value from, let's say, one vehicle to another, Jeff, what are your thoughts around Bitcoin, as you mentioned? Do you think that that's something that is going to be a sustainable, store of value over the coming years?
The store of value question, that's still a question in my mind. Do I think Bitcoin and some cryptos are going to do well? Yeah, I do, probably. The store of value, that debate's still out there. We don't know. We haven't been through something yet to where we see how investors react if they do rush into Bitcoin along with gold. Gold's the more proven store of value, obviously, with the 3,000-year history. But I do think they're going to do well. That's why I want exposure to them. And I think for Bitcoin, it goes beyond the store of value thing. There are other ways that the crypto system can help society and benefit society. And I do think that's probably going to be a trend in motion as well. So I want to ride that as an investor. But I think there's some core things that the crypto revolution can do for us as a society. And so I do want to be part of that. I'm less concerned or looking to Bitcoin as a store of value. If I want store of value, I'm just going to go to gold, quite frankly.
So in your opinion, it's more of a speculation than a store of value play.
For me, it is, yes. I look at Bitcoin and most cryptos probably aren't going to be around, right? A lot of those are going to fall by the wayside, but Bitcoin is going to be around and some other solid cryptos. So I'm looking at that more as an investment, as a speculation. I kind of look at them as I do my mining stocks. I think they're going to do well, but there's no guarantee. So I do look at it more as a speculation, but I definitely want to be involved.
Mm-hmm. So exactly as you're saying there, Jeff, you have been in let's say the analyzing the mining stocks for a long time. So could you give us a couple of the ones that you're looking at and maybe give us an idea of why maybe they're undervalued, please?
Sure. So I do own a lot of mining stocks, and I can't give my whole portfolio in a podcast, but and again, let me just emphasize, people probably shouldn't do what I do because I don't own a lot of producers, for example. I tend to eat further down the food chain with the juniors and developers and pre-producers and things like that. That's where more excitement tends to be. So instead of trying to hit singles with producers, I'm trying to hit doubles and triples and home runs and even grand slams with some of the other companies. In the big picture, the first thing I would say is that gold and silver equities are still undervalued. So even though they've gone up a lot this year, They're still undervalued. They're still a buy, in my opinion. They've been pulling back for 4 months now, along with gold and silver. So I've actually been doing some selective buying recently. If you measure gold stocks relative to gold, if you measure it relative to the S&P, if you measure just their price relative to history, all those measures show they're still undervalued. The chart looks like this with gold stocks relative to anything else. And what we've seen this year is just a little hook at the end of them going up. So I think there's still a humongous potential for gold and silver equities. Now, that doesn't mean to rush out and just buy everything today. You want to be selective, buy in tranches like I do. But to answer your question, I think the ones I like best, I do like, if you want to get a producer on the gold side, Agnico Eagle is one of the best, longest track record, best companies out there. Excuse me, Barrick Gold is another one. I didn't used to like Barrick. They had a lot of debt, and I didn't like some of the things they were doing. But then Mark Bristow came on board and became the CEO. He used to be the CEO of Randgold when they merged with Barrick, and I really liked him. I've actually interviewed Mark Bristow before. This is a very down-to-earth, no-frills guy whatsoever. If you ever heard any interview from him, you know that. So when he came on board, and meanwhile Barrick had been paying down their debt, this became a buy for me. So Barrick would be another one I would look at. On the silver side, I only own one producer, and that's First Majestic Silver. And they have a tax issue that's outstanding that's kind of kept a lid on the stock. They've been actually one of the underperformers in 2020. But that's going to get resolved at some point. It's held some institutional funds back because some of them have mandates where they cannot buy a company with an outstanding legal issue. So that's kept a lid on the stock. When that lifts, hopefully that'll be in 2021. That's going to be a major catalyst for the stock, and of course higher silver prices. But I do know management at First Majestic. I've been to their mine sites in the past a couple times. So I'm very comfortable with that company and knowing them. And by the way, they just started a dividend policy. So the dividend will kick in, I believe, in Q2. It'll be based solely on earnings. So they're firing on all the right cylinders right now. They're going to grow production. There's probably going to be M&A also in 2021 with that company. That's just my opinion. So there's a lot of things there. So once silver starts to move higher, once that tax issue gets resolved, boy, I just think that stock is going to fly. And then on the pre-producers, my favorite strategy is the pre-producer, and that is a company that is going to go into production. And if anyone's heard any of my talks, I really love that from construction decision when they say we're going to build a mine up until first pour. That time period is about a year and a half. Louis James, by the way, at Independent Speculators, done a lot of research on this. In fact, he was the first one to really do a comprehensive research project on it. And it really shows that from construction decision to first pour, there's a 90% chance of a 90% return in the stock. That's an amazing track record. And this goes back years. So that pre-production sweet spot, there's a re-rating because they go from just developing a project and spending money to actually generating revenue. And there's a lot of excitement when a new gold company comes, begins production. And that usually drives the stock up. There's a re-rating there. Because it's fairly predictable and you get a pretty nice return, that's one of my favorite strategies. So the companies that fit in that strategy right now would be Pure Gold, although the catch with them is they're about to do first pour any day now. So I wouldn't run out and just buy that and expect a 90% return. The thing with that company is, though, they're onto a 7-kilometer stretch there. And so there's going to be more potential there a lot. So while I will definitely take profits, I always take profits at first pour, I'm going to be holding on to a position in that. Other ones I like are Silvercrest Metals. That's just a wonderful company. I've met the CEO there. I've actually talked to him in person before. And then let's see, down on The development side, probably my number one pick there would be Marathon Gold. Now, again, I'm giving you things I own. So full disclosure, I own these stocks, but these are the ones that I want to own. These are the ones I think that are the best. Marathon has a good one. They're in development, so there's a ways to go with that company yet. I also like Integra Resources. I actually don't own that. I'm looking to buy it, so that's another one that someone might want to look at. I don't own a lot of royalty companies. They've run up a lot. They've been investor favorites for a long time, but those are pretty good bets if someone wants to get into the royalty space. On the exploration side, there's probably three on the gold side that I'm really excited about right now. One is Liberty Gold, the other is Go Gold, and then the third would be Maple Gold. There's a lot of, intriguing or compelling aspects to each of those that are all different. But if someone wants to research those, they might be a good place to start. Those are ones I'm particularly excited about. Just be careful with Liberty Gold because it's already done a 5X here in the last 12 months. So if you do decide to buy that, only buy it on dips. On the silver side, for me, it's probably Discovery Metals. They're already sitting on 1 billion ounces of silver equivalent resources, so there's a long way to go with that company. And then Reyna Silver, Reyna. The reason I like that is because it has a top geologist for Mexico that's backing that, and it's property that Mag Silver owned and put into Reyna, and they've not found the starter source of that whole vein system. So if they can find that, there could be something potentially very exciting there, maybe even very high grade. We'll see. They're just starting drilling now, so it's probably not too late to get into that story. And then if you want a prospect generator, there's a lot I own. Probably the one I'm most excited about right now would be Midland Exploration. They have a ton of projects. They're in Quebec, so it's a safe jurisdiction. But that's one that might be worth taking a look at. I own a lot more, but those are ones that I'm particularly excited about right now.
So Jeff, is there any real, let's say, big overview considerations that you could kind of apply to a handful of these at least, or most of them, that makes you comfortable wanting to buy them?
That's a great question. I'll give you the rundown in 1 minute. Basically, there's 3 criteria that I start with. They have to pass all 3 criteria or they go off my list. First is management. A lot of people say that, but you really have to look at management, look at not just that they have experience, but they have successful experience. What was the experience before with other mining companies they've run? Did they create shareholder value? Bottom line, did the stock rise when at their tenure? That's what you want to know. So management is definitely number one. If the management is questionable, why invest there? Just go with the best. There's enough good ones out there that someone doesn't need to invest in subpar management. The second thing is, lost my place here. Is the political jurisdiction. I've created my own little cheat sheet, and someone can do this themselves. Just Google Fraser Institute Mining Country Survey. And that'll give you a survey that was completed by miners themselves in these individual countries, and they rank them. And if they're not in the top third, I just, now I may miss some opportunities. There's a big deposit down in Ecuador right now. It looks pretty exciting, but I don't want to invest in Ecuador, Not that it's a horrible country, but politically for mining, they have not been the most supportive. And so I don't want to risk my investment on that. Again, I may miss some opportunities, but why take additional risk when there's plenty of good jurisdictions that are out there? And the third would be the nature of the property. It has to be big and rich. That's what you want to look for. Go big or go home. That whole saying that a lot of people say. It's got to be very compelling. And, I'm looking for a lot of red flags there as opposed to just I want something big and rich. I'm trying to look at all the different factors to see if there's anything that would cause me to eliminate it. There's a lot of good, maybe properties out there that look compelling, but maybe really aren't when you start digging down into it. So those are the 3 things I look at. And if it doesn't meet all 3 of those criteria, I let it go. because there's thousands of juniors out there. So there's no reason to, invest in something that's more risky. Just invest with the best. And I think you'll be fine. I really, at least you'll have lower risk and you'll have a greater chance of achieving not just a double, but maybe 3, 4, 5, 6x, and 10x and more as we go through this bull market.
Excellent, Jeff. Well, thank you very much for all that advice. Is there anything else you'd like to mention as we wrap up here?
Well, if anyone wants my ideas, what I look at, and again, I don't necessarily think most people probably shouldn't do what I do, but if you want ideas, at least you can follow me on Twitter. It's at The Gold Advisor. I did promise I would reveal all my personal buys and sells and all that on Twitter, and so I have been doing that. So someone is on Twitter or wants to join, you can go to my handle and just scroll through my history and you'll see what I've been buying recently. So, and then probably the best thing that someone can do if they're doubting whether this bull market is going to continue or not, if you believe the vaccine might hurt the gold market permanently, I don't believe that. But if you have some doubts about that, go look at Mike Maloney's Hidden Secrets of Money, especially episode 7. Episode 7 is the one that is the most pertinent right now to what's taking place. This is a movie quality video that is very well done, very informative. It's fun to watch. It's entertaining. But I think it'll really kind of help you decide whether you think you need to, stay in the gold bull market, maybe increase your exposure or exit. And you can find that on our website at goldsilver.com. Absolutely.
It's a great production. It's a beautiful, it's very visually beautiful. And it's actually a place where I started to learn a lot of the fundamentals behind the gold and silver picture when I got into this space too. Jeff, thanks very much for your time today. And we look forward to having you back in the new year.
Well, this was great, Tom. I hope it was useful. And yes, I look forward to it again next year.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.